Welcome to Talk Tickers. You're busy, but you still need to know what's driving the markets.
And that's where we come in.
Exactly. Today, we're cutting through the noise of Xylem's latest earnings call. You know, the company that operates across, well, pretty much the entire water cycle.
Right. A big player.
So, what's the essential intelligence you need to take away from this call? Let's dive in.
Okay, so Xylem kicked off 2025 pretty strong. Their first quarter results actually beat expectations.
Building on momentum, it sounds like.
Yeah, definitely building on what they had going. Demand looked resilient, and importantly, their book-to-bill stayed above 1.
Meaning more orders coming in than going out.
Precisely. And revenue saw growth across, well, all their business segments.
Nice. And margins.
EBITDA margin expanded 120 basis points. That translated into double-digit growth in EPS.
Solid numbers. And the outlook?
They're standing by their full year 2025 guidance for both revenue and EPS. It's assuming, current tariff levels stay put.
Okay, a good start. So let's get a bit more granular. You mentioned demand and that book-to-bill. What's the detail on the backlog?
Right. So the ending backlog stood at $5.1 billion. Pretty substantial.
Definitely.
And yeah, that book-to-bill above 1 for the quarter confirms new business is still outpacing shipments.
But were orders up overall?
Actually, orders were slightly down compared to last year, specifically in WSS, Water Solutions and Services, and MCS, Measurement and Control Solutions.
Oh, why was that?
They pointed to some really tough comparisons from a strong prior year. So not necessarily a demand drop, more like normalizing from a high point.
Got it. Okay, and how did the revenue growth break down by segment? You said it was up across the board.
Overall revenue grew 3%. MCS, Measurement Control Solutions, was the real driver there, up 6%.
What fueled that in MCS?
Mostly energy growth, things smart metering. That strong energy piece was offset a bit by water delivery calibration adjustments.
Okay, what about the others?
Water infrastructure was up 5%. That was driven by treatment and transport demand, particularly if you exclude China from the figures.
Right.
Applied water grew 1%. Building solutions helped there, but it was partly offset by some impacts from their 80-20 walk-away strategy. We can touch on that later.
We should. And last one.
Water Solutions and Services, also up 1%. Services strength helped balance out some, weather issues they had down the southeastern U.S.
Always something, isn't it? Okay, let's talk margins. You mentioned the overall improvement. That 120 basis point jump is significant.
It really is. Overall, EBITDA hit 20.4%. They attributed it mainly to productivity gains from their simplification efforts.
Makes sense. Cutting complexity often helps.
Exactly. And pricing actions also helped. Those factors more than outweighed inflation and some, mix shifts.
But you hinted it wasn't uniform across segments?
No, a bit more nuanced. MCS margin was actually down 170 basis points year over year.
Oh, despite the revenue growth. Why?
Primarily that energy versus water mix issue we mentioned. The energy side has a different margin profile right now.
But sequentially?
Sequentially, it was up from Q4. So some positive movement there.
Okay, encouraging. And the other segments?
Water infrastructure saw a really strong improvement, up 290 basis points.
Wow.
And applied water had the company best improvement, 300 basis points.
Very impressive.
Water Solutions and Services, though, was down 60 basis points. Mix and lower volume were the culprits, although productivity and price cost helped buffer it a bit.
Right. So a mixed bag on segment margins, but overall positive. Now, tariffs, always a hot topic. How are they handling that?
Well, their full year guidance assumes things stay as they are now, tariff-wise.
A necessary assumption, I suppose.
Yeah. They sound confident they can offset additional costs through pricing and supply chain actions.
Like dual sourcing.
Exactly. They mentioned strong Q1 performance, and favorable FX could also provide a buffer if demand softens due to tariffs. They've cut China imports significantly already.
What about Mexico and the EU?
A lot of Mexico imports are exempt under USMCA. They estimate the net increased cost for Mexico tariffs at around $30 million. For EU imports, mostly water infrastructure products, they're looking for alternatives to just passing on costs via price hikes.
Okay, proactive management there. Let's zoom back into that guidance. You said reaffirmed, but I thought you mentioned a tweak.
Yes. Good catch. They slightly raised the full year reported revenue guidance, now expecting $8.7 to $8.8 billion.
Up from?
$8.6 to $8.7 billion previously. So that's 1% to 2% reported growth.
But organic is unchanged?
Correct. Organic growth guidance stays at 3 to 4%. FX isn't seen as a headwind anymore, but divestitures will clip about 1% off sales.
Interesting point about holding back tariff pricing impact until they see demand effects.
Yeah, bit cautious there. EBITDA margin guidance is still 21.3 to 21.8%, so 70 to 120 basis points expansion.
And EPS.
Also unchanged, $4.50 to $4.70.
What about the near term, Q2?
For Q2, they expect reported revenue growth of 1 to 2%, organic 2 to 3%.
And the margin for Q2?
Expected around 21 to 21.5% EBITDA. Importantly, though, they flag that MCS EBITDA margin will be down significantly year over year in Q2.
Ouch. But improving later.
Yes, they expect sequential improvement in the second half. Q2 should be the low point for MCS margins.
And cash flow.
Free cash flow margin target is still 9 to 10%, but they noted 2025 will be impacted by some restructuring costs.
Okay. It sounds like there's a lot happening beyond just the quarterly numbers, strategic shifts.
Absolutely. They kept highlighting how their simplification program is progressing, making them more agile, boosting productivity. You see that in the margin expansion.
And acquisitions.
The AOQA integration is apparently ahead of schedule on cost synergies, and they're seeing revenue synergies pick up momentum too.
Or are they looking for more deals?
They mentioned an attractive M&A pipeline focusing on advanced treatment, intelligent solutions, and services.
Like that recent VCOM deal.
Exactly. VCOM is in zero liquid discharge technology, basically eliminating wastewater, a big sustainability play. That acquisition really fits that strategic focus. Plus, ongoing portfolio optimization through divestitures.
And internally, I think I heard about some organizational changes.
Yes, a pretty significant realignment. They're aiming for more customer focus, more accountability.
How so?
They now have 16 division GMs with end-to-end P&L responsibility, giving them more ownership.
That usually involves some headcount changes.
It did. A reduction of about 2,000 colleagues was part of this restructuring. They've also set up an enterprise solutions group for customers needing portfolio-wide solutions.
Is it working?
They mentioned employee surveys show positive feedback, indicating it's getting easier to serve customers and, for employees to do their jobs.
Okay. And that 80/20 initiative you mentioned earlier, how does that fit in?
Right, 80/20. It's about focusing efforts. The idea being 80% of the value comes from 20% of the customers or products.
So streamline and focus on the core.
Pretty much. Reduce complexity, focus on key customers. They did say it's causing about a 1% headwind in the guidance currently.
Where's that impact felt most?
Mostly in applied water and water infrastructure, as they strategically walk away from some less profitable business.
Okay. Makes sense strategically, even if it dings revenue slightly short term.
Yeah.
Finally, let's circle back to MCS, given those order and margin dynamics.
Yeah. So while Q1 orders were a bit choppy, they expect a positive book-to-bill for MCS in the second half.
Suggesting orders should pick up again.
That's the expectation. They said general bid activity is strong, win rates are holding up, and that energy piece of smart metering is really growing fast.
And the margin pressure is definitely just the mix issue.
Primarily, yes. The energy water mix. Yeah. But again, they see Q2 as the trough, with sequential and year-over-year expansion expected later in 2025 for MCS margins.
Okay. Lots of moving parts, but seems like a clear plan. That brings us nicely to our This Is Not Financial Advice segment.
Emphasis, as always, on the not.
Absolutely. So based on this deep dive into Xylem's call, what's an outrageous but plausible trade idea that springs to mind?
Okay, here's one. Given how Xylem seems to be managing tariffs, their supply chain diversification, plus that expected back half margin recovery in MCS, consider a pairs trade. Go long Xylem and short a competitor. Maybe one that's, much more reliant on tariff-hit Chinese imports and doesn't have Xylem's kind of portfolio breadth.
Playing Xylem's resilience against a more vulnerable peer.
Exactly. It leverages Xylem's potential margin upside while maybe hedging against broader trade uncertainties.
Interesting. Okay, I'll throw one out there too, sticking with outrageous but plausible. Xylem's clearly targeting acquisitions and advanced treatment. VCOM proves that.
Right.
So maybe look for a small private company, one with really unique tech and a specific niche, maybe zero liquid discharge or some kind of intelligent water management AI.
A speculative long on a potential target.
Yeah. The bet is Xylem's M&A team spots them and buys them within, say, the next 12, 18 months. High risk, obviously.
Very high risk.
Yeah.
But potentially high reward if Xylem continues down that M&A path as they indicated.
Definitely predicated on their stated strategy.
And just to hammer it home one more time, these are not financial advice, just thought experiments based on the call. Always do your own research.
Couldn't agree more. So wrapping this up, Xylem's first quarter really shows a company executing its plan in, well, a pretty dynamic world.
Yeah, the focus on simplification, the strategic M&A, navigating tariffs, it sets an interesting stage for the rest of 2025.
It certainly makes them the company to keep an eye on. What stood out most to you listening today? We always encourage you to continue the conversation and share your own thoughts.